Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Briggs, and let's get you up to speed on this afternoon's market action. You can see stocks a bit mixed. You had the Dow and S&P holding on to gains. The Dow actually up 316 points. The Nasdaq, though, trading to the downside, off just about 0.6%. Leading the action today is the energy sector. And let's take a look at oil, because oil jumping after OPEC Plus announced that it would start cutting production by more than 1 million barrels a day. We are going to break down what it means for oil companies and investors coming up.
And it's a heavyweight matchup. WWE and UFC parent Endeavor agreeing to merge. Endeavor will hold a 51% stake in the new company, while WWE will get the other 49%. Both stocks trading to the downside. We'll have more details and why that's happening coming up. But let's get you up to speed first on oil. WTI crude up. Let's check it out, 6.5%. About an hour before the close, after OPEC producers announced major output cuts. Yahoo Finance's Inez Ferre here with the very latest. Hi there, Inez.
Hi, guys. Yeah, it is huge for energy stocks, for oil, what OPEC Plus announced today. If you take a look at our Wi-Fi Interactive, we're looking at XLE that's up 4.79%. It had been up around 5% earlier today. And some of the biggest players, let's take a look at the energy stocks here. You will see ExxonMobil up more than 6%, Chevron up 4%, Energy Total up 7%, or Total Energies, I mean, and also Shell up more than 5%. By the way, these are some of the trending tickers on our Wi-Fi Interactive page as well. So the energy stocks today are trending. They are soaring. Now, some would say that energy had been oversold. You had WTI at around $70 a barrel, less than $70 a barrel just a couple of weeks ago. So you could say that you are seeing a bit of a short squeeze when it comes to these energy stocks as the underlying commodity has risen today. Goldman Sachs is saying that they could see oil surging to $95 a barrel, up from 90 by the end of the year. Capital Economics is also saying that they could see an increase in oil prices to they're increasing their forecast to $90, up from $85. Guys.
Yeah, Ness, one of the things that Goldman Sachs did highlight in their note was the political aspect of this. And amidst all of this, the White House did respond to these output cuts, saying, quote, "We don't think cuts are advisable at this moment." We know that the Biden administration still has not refilled the strategic petroleum reserve, even when prices dip below $70 a barrel. What do you think this means just in terms of the rising oil prices, what it means for the U.S., and of course, the Fed's fight against inflation?
Yeah, that's right. It's not great for the fight against inflation. As far as what some analysts see in this, they are saying that this OPEC Plus decision is a sort of geopolitical posturing because of that SPR that you were just mentioning that hasn't been refilled, when officials had said that they would want to refill when oil got to around $70 a barrel. But look, there's a couple takeaways here. One is that Saudi Arabia and other countries that are big exporters in oil, they depend on oil. They need to keep that price at a certain level because of their budgets, and the OPEC Plus is willing to make these cuts. And the assumption is that if oil goes down more, that they would be willing to even cut more, that they are willing to take these preemptive actions. Certainly not great for the relationship between Saudi Arabia and the U.S., but certainly some analysts are saying, look, they want to see oil. They would like to see Brent even at $90 a barrel, guys.
Indeed. Inez Ferre, thanks so much. Appreciate that reporting. As we said, oil prices spiking on OPEC production cut. So what was the instigator here? It is $100 barrel oil on the horizon. Let's discuss this with Blue Line Futures President Bill Baruch and Neil Dingman, Truist Managing Director, Energy Research. Good to see you both. Bill, we'll start with you. How much did geopolitics play in here, and how much is strictly the price action we've seen in recent weeks and months?
You know, I think there's quite a bit going on behind the scenes here. White House didn't fill the SPR, but they had a little bit of an opportunity to. At the same time, there's a lot in the news right now with China making deals with Saudi Arabia, making deals with Brazil, trying to go around the dollar potentially. There's definitely some just interesting narratives to keep in mind here. For me, what I'm seeing is we've got a somewhat negative at the end of last year on oil. It's difficulties of trying to get above 82, 83 on a technical basis, losing the speculators in the market. You saw open interest just continued to erode into the end of last year. And we finally got the flush out, really a cleansing in the last week was the bottoming process that really began through into last week. At a 5% move last week on Monday, another more than 5% move today. We haven't had a 5% move in oil going back to November, and then prior to that was May. So these are big moves here, and I think that cleansing allows the the speculators to start maybe coming back, a little reaffirmation now with this move. But we got to get above $82 to $83. It's been a really big ceiling there. So until that happens, this is just a nice big little bounce up rebound.
Well, here we are today, just above $80, just below $81 a barrel here. Neil, how has this at all changed your price forecast, either for year end or even out into 2024?
I think it does put a floor on prices, and I come at it a little bit different angle. I think about my producers. I cover almost 40 odd names, and what's interesting, I think at one time the U.S. producers were, I would call them the swing factor when it came to supply out there. And what we've seen is prices were over $90-ish not terribly long ago. Then they recently were down to $60. What I noticed from almost all of my public companies, they're not changing their plans. So I think what the U.S. administration realizes now, as much as they might want it, the U.S. is not going to be that swing supplier. Unfortunately, now that's looks like it is in the hands of OPEC plus, most likely, specifically Russia and Saudi, and they stepped in and made a big call where 5 years ago plus the U.S. companies probably would have stepped in and made the call themselves, and that to me is just no longer going to happen.
Bill, you referenced the Strategic Petroleum Reserve. What position does this put the White House in terms of it filling that at some point in the near future?
I think they're going to be stick to the narrative they said about a month ago, that they're going to look to, in the future. I think they're probably looking out to later this year, potentially, if they get another opportunity. But I do agree, with the gentleman here that he's saying that there's a floor in the market now. And I think looking at it from technical basis, 75 area was the close on Friday. That's going to be basically that gap. If it does start selling off, there's an air pocket there. I also agree that you're not seeing production, coming back online from the U.S. They're going to struggle to get above 13 million barrels here in the U.S. And then on top of that, it's expensive these oil services companies have raised the cost. Just logistically, it's hard to justify bringing it online. And then these energy companies have become lauded by investors here with the dividends. So sort of affirming the dividends. And I think that they're looking at it from a different game here now. And these companies, we're very overweight energy. We added Pioneer early last week and bring us up to about 15% weighting in energy right now. And my fear really was some of these E&P companies tethered to that price of oil. If oil wasn't going to rebound, they could sort of languish a little bit lower. But this does get me excited. I still want to see more from the market in the underlying crude oil, but I am excited for this to be reinvigoration of a bull move.
Neil, you mentioned the several producer companies that you do cover. Of those, who's best positioned here to benefit from today's news?
I think you have a name that comes to mind right away is Occidental Petroleum. You look at Oxy, and the knock was they still had a bit too much leverage. But again, in a market like this, where as Bill said, you probably have a new floor. People don't worry about that. You have Buffett coming in and Berkshire buying a lot of that stock. So Oxy seems to be sitting very, very nice. Another one you look today is doing very well is Marathon MRO. Again, Bill was talking about, you talked about shareholder return. Marathon bought back almost over 15% of their stock last year, and we think they'll buy back almost the same. So you look at it in a 2-year period, buying back almost a third of your shares. That's hard to beat. And then maybe the last one that we would say is Diamondback Energy. We think they are, Bill hit a key point, and that was service costs are going down. But if you look at FANG, they are by far the lowest operator. We have them at a break even of less than right around $30, which is much less than anybody else. So, a time of higher prices, you don't worry as much about cost, but their margins just hit right to the bottom line, and they're just a fantastic producer.
Bill, do you have any names? And we talk about a floor there. What about the ceiling by the end of summer? Is $100, is $95 as Goldman Sachs suggested possible?
Yeah, I think 100 could be a little bit of a magnet, but I'm not going out on a limb just yet. I got to see a weekly close above 82, 83 bucks. Like I said, we are, you mentioned names. We're 15% weighted in energy right now with Chevron, Marathon Petroleum. I mean, we really do like the refiners. You're not seeing Marathon Petroleum benefit so much here today, but seasonally, gasoline hits a very bullish time at the end of March, really into Memorial Weekend, and some of these refining margins can be a tailwind to some of those. So we like Marathon Petroleum, Schlumberger we own as well. We've had Pioneer for a while. We cut at the end of last year, just kind of worried about a washout in the market. We finally got that washout, and that's why we added Pioneer back. But from another standpoint, we saw in the futures contract there was a massive short position that was actually that last week's move was really a lot of short covering early on, confirmed through the commitment of traders. So I think this move here is welcoming fresh buying, because the move up from the below 70 to about 75 was majority of short covering. So I think this is inviting the speculation back, and the open interest, as I mentioned early on, was very low. So I think we can get above 82, 83. It's not going to happen overnight, but if we get above there, I think this could really start invite some fresh buying into the market.
Bill, what do you think it means for gas prices? Because we're getting into pretty soon, sooner than we know it, getting into the heavy summer driving season. Are we going to see gas prices back above $4 a gallon?
I'm not jumping on that limb quite yet, but I think I would imagine so. I mean, usually these things run up into June, and they stay sticky through the summer. So, from the makings of what we're looking at right now, I imagine we're going to see these bump up here for the next couple of months.
All right, Bill Baruch, Neil Digman, always great to have you. Thanks so much.
Thank you.
Let's do a quick check of the markets sponsored by Tasty Trade. Again, Dow and S&P holding on to gains in the final hour trading. You're looking at the Dow up 314 points, S&P up just about 0.2%. Energy by far the leader in today's action. We've been looking at them all day, but some of the big names, Exxon up just over 6%, Chevron another huge gainer in today's action. ConocoPhillips also among the outperformers today. Well, we are just getting started here on Yahoo Finance Live. Coming up, Tesla setting a new record for deliveries, proving that its price cuts are working, but the stock is falling today. You can see it off just about 6%. We'll speak to Tesla bull Dan Ives on what's behind today's drop. And a massive merger, WWE teaming up with UFC parent Endeavor. We've got more on that straight ahead. Don't go anywhere.
All right, shares of Tesla trading down more than 6% today despite record deliveries in the first quarter of the year. That deliveries number coming in at nearly 423,000 vehicles, up 36% since last year. The EV maker releasing the numbers on Sunday. We'll get full Q1 results in about 2 weeks. For more on this, let's welcome in Dan Ives, Wedbush Managing Director and Senior Equity Analyst. Also a Tesla bull. Dan, good to see you. You like these numbers. You were digging them, man. Why are investors not?
Yeah, look, I think it was just a knee-jerk reaction after a stock that's basically doubled, so far the first 3 months of the year. They beat what I'll call whisper numbers. Now I think maybe some might have been hoping for more of a beat given the price cuts. Now the debate will be margins going into April 19th. I believe margins, they held the line relative to how they guided. So I think overall, this is a major step in the right direction, a murky macro when you look at competitors.
Dan, what about the fact, though, that they did fall short of the pace that's needed to attain that goal that Musk laid out in terms of 50% annual growth? Is that still attainable?
But I think 50% was really something they took off the table on the last earnings. Now, granted, the longer term 50% goal, but really the number that the street investors are focused on is 1.8 million. And I think if you look at that, they are on or actually ahead of that pace. And that's why right now, of course, there's a lot of bulls and bears in terms of that tug of war. Despite the stock doing what it's doing, I think the bulls ultimately won this battle.
But Dan, ultimately, it comes down to this price action. We're talking about a market cap almost 3 times Toyota, $602 billion for Tesla, $231 billion for Toyota. Is that even near justified with the demand we're seeing for Tesla?
Look, and that's always the debate, right? If you look going back to Tesla Mini, they hated it at $5 billion. They despised it at $1 trillion and pulled the hair out at $600 billion. I just have always viewed it as a disruptive technology player and not a traditional auto player. That's why I view apples to oranges when you compare them just to the likes of a Toyota or others. I believe they deserve more of a disruptive tech multiple. And I think that's what you've seen happen to the stock, especially over the last few months. Now, with that said, they're held to a higher standard and they need to continue to produce. But I still think we're in the early innings of this green tidal wave playing out. A $5 trillion market in terms of EVs.
Dan, what about the price cuts? Clearly, they are helping sales right now. Now there's talk of further price cuts ahead. Do you buy that, given the fact, and put it in your own words, the murky macro picture right now?
Look, but they've had to ultimately rip the Band-Aid off. I think that was the smart poker move that Musk did earlier this year. It's a big reason why the stock's up. Now, of course, the debate will be, do they need to do more price cuts? I think in China, you'll see some more slight price cuts, potentially in the U.S. as well as the arms race plays out. But because of their margin structure, it gives them so much more flexibility than other vendors to do these price cuts. And I think that really continues to be the story here, especially as battery costs ultimately get reduced over the coming months and years.
All right, meanwhile, Rivian also has some numbers out. Deliveries down 7% in the quarter. That stock down a little more than 2%. What does this mean?
Look, Rivian's been a nightmare, right? Because on one hand, you have a great story in terms of the production, in terms of what I view as an innovative vehicle, the Amazon partnership, but every quarter it's been dog ate the homework, the wind blew it over, I was late because of traffic. Name an excuse. I think investors have gotten very, very frustrated. This is clearly a slight positive, but ultimately more wood to chop. They now need to execute to what I believe could be the power of the Rivian story.
Yeah, Dan, lay out the bull case for me, because I think a lot of people are struggling really to see the growth opportunity and what Rivian's even going to look like a year from now.
The bull case is that they'll have enough capital to navigate this. They could raise more capital. If you look at the opportunity, if you call it 10, 15% of traditional pickup or even sport utility convert to EVs with where Rivian sits, you look over the coming years, there's a company that could be doing in the hundreds of thousands of vehicles rather than 40 or 50,000. As that plays out with eventually what will become a positive margin story, that's the holy grail. But look, I think as we've seen with Rivian, we've seen it with Farley and Ford. Look at Lucid. Easier said than done to actually produce and get these vehicles to customers' hands. And I think that's why Tesla continues to be their world. Everyone else is paying rent, with obviously others chasing them, GM included.
I got to ask you about Tesla only via Elon Musk, who's also running Twitter. And the big story is this blue check. I know this is not a public company anymore, but Dives Tech is everyone's favorite Twitter account. Are you going to pay this $9 a month to maintain your blue check? Is he doing anything right to inspire confidence that a Twitter turnaround is coming?
Yeah, look, David, great question. I think the big thing is, and of course, Briggs, one of my favorite Twitter follows as well, especially with NCAA. But look, it comes down to, I believe this is something where that overhang is starting to dissipate. You're starting to now see more of a break-even Twitter business. It's going to be an uphill battle to monetize, right? If you got into an Italian restaurant in the last 20 years, bread's free. Now they tell you bread's $4. It's going to be tough to monetize that. So this is going to be a bit of an uphill battle, and it always has been with Twitter, for paying $44 billion for something that I believe is worth closer to $15 to $20 billion.
Are you buying bread?
Again, that's going to look. I'm a believer here. I'm a believer here that it's going to ultimately appeal to some consumers and some organizations, but ultimately, I think this all needs to play out in terms of that blue check. And especially, look, for someone like yourself, now with the succession and everything else, so you're probably more of a blue check type person, but we're not all in the Briggs category. So
you're really inflating his ego here, Dan. I've got 2 hours left with him.
Oh, Dan Ives is a legend. Good to see you, sir. Thanks so much. Appreciate that. All right, coming up, Disney CEO Bob Iger speaking at the company's annual shareholder meeting today, his first meeting in 3 years, and he came out swinging. We'll tell you what lies ahead for the House of Mouse with Needham's Laura Martin. Other side of the break.
To all who come to this happy place, welcome. Here age relives fond memories of the past.
That was just the start of Walt Disney's annual shareholder meeting today, with CEO Bob Iger also taking questions from investors after the presentation. In one response to a query about Florida Governor Ron DeSantis, Iger called the governor's policies, quote, anti-business. Now, shares of Disney not moving much on the event, but we want to dig in further on Iger's plan with Needham & Company's senior media internet analyst, Laura Martin. Laura, always nice to see you. It was a bit of a surprise to see Iger come out swinging against the Florida governor. What's your reaction?
My reaction is I think Iger's 15-minute introductory speech was perfect. He's like, we're 100 years old. We've been at the top of our storytelling game for the last 100 years. As an aside, I would say a lot of that is thanks to him because he bought Marvel, he bought Star Wars, and he bought Pixar. Otherwise, Disney might not still be at the top of the storytelling game. And he just said he's going to add 17,000 jobs and spend $17 billion in Florida, which is new jobs. So I think politicians come and go. I think DeSantis is running for office against Trump that's his hidden agenda. And I think the Walt Disney Company will be in Florida for another 100 years, and DeSantis won't be.
But the thing is, DeSantis isn't running against Trump. He's not saying a word about Trump, even with an indictment looming. He's talking about people like Bob Iger and companies like Disney. That's actually who he's running against, this boogeyman of a woke agenda. Do you think this is just awakening a sleeping beast here?
No, I think it is all politics for him, for his hidden agenda. And I don't think politicians persist. But I think the Walt Disney Company will be here in 100 years. And sticking to the messaging of freedom of speech is important. The right to share, have different ideas is important in America. And we, the Walt Disney Company, have a different point of view that we have the right to espouse. I think all of that is good messaging.
Laura, you mentioned one of the other big headlines coming out of this investor day is a $17 billion investment in Walt Disney World over the next 10 years. From an investor standpoint, how big of a catalyst do you see an investment like that potentially being here for the stock?
You know, parks are at unbelievable margins. I've covered this company a long time. Parks are really the highest return on capital business right now. And what Disney does better than anybody is apply engineering to turn dreams into reality. It's like almost impossible what they do. So they have real competitive advantage here. They have real pricing power, and they are a differentiated voice. And I think Florida, like a shopping mall, the more things you put in Florida, the more likely you garner the next, family of four to fly there because they can fill more days. I think Disney's point of view is that people come for a week from all over the world. We only have 3 or 4 parks. Let's build out. And so therefore we benefit Universal Studios, or we benefit other things in Orlando. They're like, no. Let's build the next 3 days so somebody can go to a Disney park every single day of the week, and we don't have any value leakage to our competitors.
Of course, investors were hoping for some sort of update on Hulu. Will they buy that out? And or ESPN? We didn't get it. So your thoughts on what that means, and have any plans materialized over Hulu specifically and where they plan to go?
I think ESPN is the more interesting one myself, which is they're breaking it out now in their financials by the end of the year as a separate entity. I'm hoping they find an investor for ESPN, a minority investor, which brings them cash to pay down debt, but also doesn't affect their ability to control ESPN. And I think that would be really a robust auction. So sell 15 or 20% of ESPN to a third party. Hearst already owns a piece of it. And then on Hulu, my gut feel is they will own. I've never seen the Walt Disney Company sell an asset. So my guess is they're going to own it, but the put-call ratio makes it better negotiating strategy to tell Comcast, look, be careful what price you put because we might put it to you at that price. So I think they'd rather own it, but the put-call means that Comcast can buy it at whatever. It can also buy it at the price it puts forward. So, and if they can force Comcast to buy it, I think that'd be too bad for the Walt Disney Company, but I think money matters right now to this company.
Speaking of money mattering and potential M&A, you put out a note last week that got a lot of attention. Talk here about Apple potentially buying Disney and really the upside potential that you see for Apple if that deal were to ever happen. Is there any talk of this? What's the timeline of it? And why would that make sense in terms of Apple or for Disney?
Sure. So I think the key point is 100 years for Disney at the top of its game, almost no change in strategy or execution excellence. Apple has an iPhone that's 10 years old. So, and I think technology is not a moat, as evidenced by the fact that 11 years ago, Apple was 4% of the market. And as of the fourth quarter, it was 24% of the market. And what it did to achieve that is put people out of business. So what we've said is, Disney has a succession issue. We've been trying for 6 years to replace Bob Iger, who is fabulous, but he's 72. So if you can bring in Disney into Apple and keep all of its storytellers independent, but with a $90 billion a year free cash flow check coming from Apple, you elongate Apple's ability to survive because you just gave it a bigger competitive moat and longer engagement. You could make certain content exclusive. So you have to buy an iPhone to get to Moana or Lion King or, some Toy Story. That'd be cool for Apple. But the point is, I think it's better for Disney not to be independent. And it's always, my opinion, better for distribution to have proprietary content that it can give 5-day window to exclusivity, or certain content has exclusivity that makes the Apple iPhone, in this case, much more valuable, or the iOS ecosystem, if it had exclusive Disney. You can only get Mickey Mouse on iOS devices, would be amazing, I think, for Apple.
You mentioned Moana. I'm going to circle back on that in a moment, but first you have a note out saying Google is worth more in pieces than together. You welcome regulators' attempts to break it up. The prevailing wisdom was breaking up Google would be very bad news for investors. Why would it not, and might they consider an Alibaba-like move?
Yeah, no, I think that Google, we put out a piece today saying they have a product problem, as evidenced by the fact that they and Meta together 5 years ago had 80% of the total full-time employees working on AI, but yet ChatGPT beat them to market. And when they tried to demo Baird, it was a poor substitute. So, and now ChatGPT, this upstart, is now threatening the core search business. So our point of view is this is a company that doesn't have a new product commercialization culture, therefore should be broken up so that the individual pieces like YouTube or like Android are forced to live by Wall Street mandates of running a real business, not just being subsidized by that fabulous search engine that has 80% margins.
Laura, how should we be looking at who's in charge? Because that's something that you brought up in your note, but taking a step back here, Sundar Pichai obviously at the helm here of Alphabet. Is he the right person to be leading the company at this point?
I think Wall Street does not think so. I think that they are just far too, it's like the inmates are running the prison right now. They need a stronger leader that says, look, guys, we work for a business. And the business has to make money. And you employees who don't want us working with the Immigration Service and don't want to work us with the DOD, these are massive contracts that last for decades. And you can really add a lot of value to the US government. Like, I object when they don't allow these employees stop Google from getting new business for the US government. Like, I'm confused. So I think new business is good. I think Google's supposed to be running a business. And therefore, I think the inmates need to stop running the prison.
Interesting point. All right, you mentioned Moana. I promised I'd circle back. That was actually the lead of Disney's presentation today until the comments on DeSantis that they have a live action Moana coming out. The Rock had this very nice long presentation video. He's such a talented guy, which prompts me to ask you your favorite live action Disney film ever.
Lion King, easy as pie.
Yeah. Really?
I
thought that was the worst. I am really.
What is your favorite?
Well, I would say Cruella, easy one, and Maleficent, definitely two. Those two head and shoulders above the rest.
I liked Beauty and the Beast.
I mean, you like Beauty and the Beast?
Yeah, that was so good. The live action
that was solid.
awesome.
None of you saw Cruella? Or...
I haven't seen Cruella, no.
Oh my gosh,
I mean,
terrific
I might
movie.
be missing out
And Maleficent was amazing.
Maleficent,
both.
I agree. It would have been my number two, but I thought Lion King was so cutting edge at the time. And the music from Elton John, fantastic at music.
Interesting. All right, we'll have to debate this another time, Laura Martin. Always good to see you. Thanks so much. All right, before we head to a break, let's do a quick check of the market, sponsored by Tasty Trade. How we doing on a Monday? Some green on the board. The Dow up 1%. The S&P just barely into positive territory, and we've seen this interesting flip with energy driving the positive, and now tech begins to fall back down. Will that continue? Should be an interesting trend to keep our eye on as we begin the next quarter. Coming up, shares of Macy's trading higher after JP Morgan called the stock a buy. We'll tell you why. The analyst behind the call is confident in the retailer's future. Next.
It's time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading: Macy's, WWE, and KB Homes. Kicking it off with Macy's, a big jump today in shares. It's a top trending ticker on Yahoo Financial, and gains of just about 7%. JP Morgan out with a buy call on the retailer, outperformed there following recent meetings with executives. Now, analyst Matthew Boss coming away from the talks confident about Macy's future despite macro weakness, saying that it's focused on private labels, also luxury brands, as well as plans to open smaller stores outside of malls. He thinks that that's going to help the company drive sales. Now, just last week, Macy's CEO Jeff Gennette surprised many on the street with plans to retire next year. Now, he has led the company's turnaround efforts ever since taking over the helm, I should say, in 2017. At that time, there was lots of questions about whether or not Macy's was even going to survive. Top performer today, in the red though since the start of the year. Macy's without Gennette, that's a whole nother issue here. But in terms of what JP Morgan sees in the near term, lots of reason to be excited there. And a lot of the outperformance from Macy's brands, at least most recently, coming from luxury.
I mean, 2 exciting things there, Shauna. One is just the clear confidence in the full year 2023 when you talk about the top and bottom line from a big retailer like Macy's. Just to hear that, I think, is good when we think overall about the consumer, right? And then on what you were talking about with the luxury goods, you think about the next CEO that's slotted to come in here, Tony Spring, and what he's been able to do with Bloomingdale's and what Bloomingdale's and Bluemercury have been able to do for Macy's. I think investors are excited to see that story continue to play out. You think about even just this last quarter, Dave, you had Macy's comparable sales down 3.9% overall, but Bloomingdale's up 1.2% year over year, and Bluemercury up 7.2% year over year. That was from the last quarter. But just to see that outperformance from the private label brands and bringing in someone that's led the private label brands, I think is what is exciting investors here.
I think I was a little bit surprised initially by Spring as the appointment. Don't know him, but someone who has been there since 1987, hired as executive trainee, strikes me as a company that needs a whole fresh new take from outside this space, someone with a whole new digital perspective. I was a bit surprised to prove someone just from the system, a legacy guy. I think they need a complete makeover there at Macy's and Bloomingdale's. And therefore,
the Bloomingdale's loyalty program has done well, though.
It has.
I think that's about where 70% of their sales comes from. It's just loyalty. Then you think about building it digitally. I don't know the digital numbers off the top of my head, but I do know the loyalty program itself has done very well. And I think maybe that's part of what they're trying to build off of.
But the key being Blue Mercury. Build around Blue Mercury. If you're going to focus on one of their assets, that has to be it.
When we're talking about growth, we talk about exciting ideas, right? Let's take a look at another one, huh? A little tag team, if you will, Dave.
Yeah, buddy.
I like the
WWE
transition
and
there.
Endeavor. The parent Endeavor, the parent company of UFC, buying out Vince McMahon's Worldwide Wrestling Entertainment for $9.3 billion. The combined company will trade under a new ticker symbol, TKO. And Axios media reporter Sarah Fisher was reporting today that WWE and UFC will pursue separate media rights deals linearly, but there is a possibility of a combined streaming deal. And I think that's what's interesting here, Dave, when you think about what happens to the media assets themselves, right? And where does WWE go probably beyond Fox or NBC or Comcast? ESPN has done so much for UFC. I would be fascinated to see WWE on ESPN Plus and what that would do for WWE.
I would be stunned as well, given Bob Iger's comments about cuts, about savings. This will not be a cheap property. It's one of the few rights coming up, live, massive audience. I'm really curious how these personalities gel. In particular, I'm talking about Vince McMahon and Ari Emanuel in an interview over the weekend with CNBC. There was a joking moment, but it felt all too real when they were both asked, what happens if you disagree on the direction of the company? And Vince joked, we will wrestle for it, and I have 100+ pounds on Ari. It felt very awkward and quiet at that moment. I don't know how that's going to work out. This is not a guy who's going to be executive chairman that wants to sit back and be quiet about anything. I don't know how they're going to mesh culturally. Investors didn't like this nonetheless. They wanted a big buy, at least in the WWE side. They wanted a big, clean purchase, and they didn't get that.
They didn't get it, and I think that's evident in the reaction, or what they were hoping for, I should say. That's evident now in the reaction for shares. But you're right. I just think the leadership, the dynamics at play there, the culture inside this newly combined company, also add Dana White to the mix there, leading UFC. There are a lot of very big personalities.
Put that on pay-per-view.
A number of people, exactly,
watch that.
who are used to calling the shots. So now they're all going to have to come together in one room pretty often, get on the same page. I don't know how that's going to happen, but that in itself is going to be entertaining, at least, to watch or hear about.
And to your point about the hybrid, you got to think Apple or Amazon. Who has the cash to take on those two?
Well, I think that's an important part of the conversation that we had over the last couple months, right? Was, well, would Apple or Amazon buy WWE, right? Or would Netflix buy WWE?
Yeah.
The media rights are still at play here, so you could still see WWE on Apple or Amazon from a streaming side. That part of the deal is not done as far as for Apple and Amazon investors when you think about just growing their content base. That seems like something that could still be on the table moving forward.
The fan base there just amazes me.
It's
very loyal.
Diehard.
But on the surface, it looks a bit like the NBA, like the legacy players will want to keep that deal, being NBC Universal / Peacock and Fox. Will they continue to hold it? All right, I'm playing the home builders today based on some new housing data. Black Knight says prices rose nationally 0.16% in February. Yeah, not a lot, but that breaks a string of 7 straight monthly declines. It's also the strongest one-month gain since May of last year. Prices still, though, 2.6% below their peak last year, primarily a result of higher rates. We have, however, seen some relief in that regard. Most recently, the average 30-year fixed slipped to 6.32%. That's according to Freddie Mac. Overall, 39 of the 50 largest markets saw home prices fall in February. The stickiest problem plaguing housing across the country, inventory. Levels falling for the 5th straight month to their lowest level since May of last year. They're 27% below pre-COVID. Said Black Knight on this release, the unfortunate reality is that the scarce supply of inventory that's the source of so much market gridlock isn't getting any better. Now, shares of KB Homes, Toll Brothers, D.R. Horton, all were up earlier on this day when we saw this news come out. And yep, they all remain up and all up between 7 and 20+% year to date those three. So far, some momentum that things are going to be okay. There was a little bit of damage. Still don't think we're going to see the declines that some predicted.
Yeah, certainly. And then as we see prices maybe rise once again, or if this is the start of another trend here, brings back in housing affordability, which we know has been a massive topic here because low inventory, it's going to likely continue to maybe push prices higher or keep them very high. So that, of course, is a huge issue here. Applications, though, they are rising as we've seen mortgage rates come back just a bit, up 4 weeks in a row, but still off 30% lower than where they were a year ago. So the housing market, it's complicated right now. It's tough to figure out.
It's very reactionary week to week based on the rates, which we haven't seen in quite some time.
That's certainly, it's good to point out. All right, well, coming up now, oil prices surging after OPEC Plus producers made the surprising decision to cut oil output by more than 1 million barrels a day. So what does this mean for investors and the Fed? We'll tell you on the other side of the break.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc. That's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
All right, let's take a look at stocks here with just about 15 minutes to go in the trading day. We're looking at the Dow and the S&P holding on to gains. By far, the outperformer in today's action is Crude. You're looking at Crude up just about 6%. Energy, XLE, the top performing sector today. That move coming after members of OPEC Plus announced another oil production cut. Let's talk about all this, what it means for the Fed going forward. For that, we want to bring in Christina Hooper, Invesco Chief Global Market Strategist. Christina, it's great to see you here. So how should we be looking at this from a market, from an investor perspective?
Well, it's great to see you as well. I think what we have to anticipate is that it's likely to boost headline inflation in the shorter term. Not dramatically, but it's certainly going to be an upward pressure on headline inflation. Having said that, though, what the Fed is really focused on is core inflation, in particular, services ex housing. And so that wouldn't filter into that particular component for a long time. You know, there tends to be a cascading effect, but it takes some time. So what the Fed is focused on and the impact of higher oil prices are essentially in two very different places. And I don't think it's going to change much about the Fed's trajectory going forward.
What is your expectation, Christina, for the May meeting? And has it moved at all as a result of first the banking crisis and now this on energy?
Well, I've always been of the opinion that the Fed would stop hiking at around this level, maybe one more rate hike. Now, certainly when we got what I will call the mini banking crisis, that suggested to me that the the Fed, might err on the side of slightly more dovishness. But what we saw the Fed do, and really what other central banks have done in the face of other mini crises, is to roll out policy tools specifically focused on mitigating the damage from that particular crisis. And of course, we saw the U.S. government step in, come up with a special bank credit facility and address the issue that way. So that really cleared the way for the Fed to, especially now that things seem to have calmed down a lot, really focus back on inflation and business as usual. So I always thought it was somewhere around this level, maybe 25 basis points higher. Now I'm more convinced that we are going to see one more rate hike that will happen in May.
Well, Christine, in the spirit of the finals of March Madness being tonight, one of the titles here of your most recent note is, has the March Madness, market madness ended? Has it? And what do we need to look for as an indication that that actually did happen?
Well, it certainly seems to have temporarily abated. But as we know, as market watchers, never say never. But what I would anticipate is that it's largely behind us because we didn't think it was systemic. We thought it was isolated, specific issues because of specific business models. Now, that doesn't mean, though, that there isn't another shoe to drop, that another mini crisis might also be created as a result of the Fed's aggressive tightening cycle. However, I'm really confident in policymakers, not just in the U.S., but around the world, because of how they've reacted to the crises that have popped up thus far in terms of moving very quickly and effectively in terms of stemming them. So we could see some other small madness erupt, but I'm pretty confident we would be able to get past it, isolate it, and get past it rather quickly.
Of course, now we're in this strange dichotomy with jobs number coming out Friday. Markets used to cheer a strong jobs number. Now it comes with the implication that we might see higher rates. So what's your expectation for Friday, and what are the implications on the markets?
Well, I'm hoping that we don't get a number that's higher than expectations, right? It's all about beating or exceeding expectations in terms of how markets react. But the reality is that's looking in the rearview mirror. The jobs report really is not forward-looking, although wage growth does give us a good sense of inflationary pressures. And so that's really going to be the metric I'm most focused on. And again, hoping that it meets or is lower than expectations.
All right, Christina Hooper, we have to leave it there. As always, great talking to you. Thanks so much for joining. Let's get to another big story, and that is McDonald's, the company temporarily closing its U.S. offices to start the week as it plans to lay off part of its workforce. Yahoo Finance's Brooke DePalma is here with more on that story. And Brooke, what have you learned about these planned layoffs?
Yeah, well, lots of details falling out over the course of today. Layoffs are, in fact, underway at the Golden Arches. Now, we know that this is part of a larger restructuring effort to hone in on effectiveness and streamline operations at the business. Now, following this announcement earlier this year of it putting a greater emphasis on restaurant development as part of that growth strategy, what they're calling accelerating the Arches 2.0. And so CEO Chris Kempczinski hinted towards these layoffs earlier this year. Now, per a source familiar with the matter, offices will in fact be closed Monday to Wednesday of this week to provide confidentiality and respect to colleagues that are exiting. In addition to that, we know this will impact corporate office jobs, not restaurant teams, but it is still unclear of how many employees this will impact. As of 2022 year end, there are currently 150,000 employees at McDonald's. In addition to that, we heard from a source familiar with the matter that this will not be of the same magnitude that we're hearing at tech layoffs like Amazon or Meta. But we also know now that McDonald's plans to speak to all of its employees, those impacted by layoffs, in addition to others who will be informed of promotions or new roles at the company.
Interesting. Can't remember another public company taking this move to close for layoffs. How's the street reacting?
Well, shares now up about 1%, but earlier today, shares of McDonald's did in fact hit a record intraday high. That high was slightly above where it is now at $282.81. That beats its previous record intraday high previously set on November 10th of last year. But the street not seeming like this is too much of a surprise here. As I noted earlier, CEO Chris Kempczinski did hint at this in a memo to all of its employees in January. One analyst telling Yahoo Finance earlier today that this is an opportunity to reduce G&A expenses, which McDonald's tends to run heavy on, and this will allow it to move more quickly. We also saw a similar strategy taken by Wendy's earlier this year. Another analyst saying that layoffs, of course, are painful, but it's good to see that the firm is working to stay ahead of development curve despite posting those really positive results that we saw earlier this year. The latest quarter showed strong double-digit sales growth across the board last quarter, and now we're just gearing up ahead. About a month away on April 25th, McDonald's will post its next quarterly results, so certainly lots to stay tuned to in that next earnings call.
Shares up just about 1% today. All right, Brooke DePalma, great stuff. Thank you. Coming up, we're counting down to the closing bell on Wall Street. Dow still holding on to gains up 329. We'll be right back. We are minutes away from the closing bell here. Let's bring in Yahoo Finance's Jared Blickery breaking down today's action. We're looking at some gains at least to start the week.
Yes, except for the Nasdaq. So this, I guess, raises the issue. Are we now experiencing a flip from the first quarter? Because the Nasdaq was leading the first quarter while the Dow was lagging. And now we have the reverse today. one day does not a trend make. So we're going to keep an eye on that for you. And meanwhile, I do want to take a look at the longer term picture in the S&P 500. This is a year to date. Actually, this is going to be the Dow, and you can see it is now up a whopping 1.37%. But you take a look at the Nasdaq, wow, that is up 17 or 16.5%. The S&P 500 just about going to split the difference. So pretty wide differential there in terms of what has been making money. But today it has definitely not been the tech trade on fire. It has been the energy trade. And once this populates, you're going to see XLE, the energy sector in the upper left. That is up 4.5%, followed by XLV, that's healthcare. Then we got staples, or excuse me, materials staples, and then communication services. That rounds out the outperformers of the S&P 500. To the downside, it's real estate, consumer discretionary, utilities, and tech. Those are the sectors in the red there. And let me just take a brief look at the China stocks here. I was looking at them earlier today on the morning show, and it looks like we're taking a little while to populate here, but kind of a split board, seeing BABA down 3%, JD.com also down 3%, and for the most part, I would say more losers rather than winners. So not seeing. And there's the bell. Wow, creeps up on you guys.
Indeed it does. Good to see you, Jared. There is your closing bell on Wall Street. Let's check out the markets real quick, sponsored by Tasty Trade. The Dow, solid day, about up about 1% on the afternoon. The S&P just barely into positive territory, up 15 points. And again, kind of a reversal of what we saw in Q1, where the Nasdaq tech has reversed a little bit to start this week and to start this quarter. Will we see this trend continue? Should be interesting given what we've seen from the energy markets.
All right, let's take a look at some of the big movers of the day. First up, we got to talk about oil and some of the energy names. Now, OPEC Plus's decision to slash production by more than 1 million barrels per day, causing some headaches maybe for the Fed when it comes to its fight against inflation, but undoubtedly good news, at least for now, for big oil. You're looking at gains across the board in some of these larger oil plays. Exxon, Occidental, also Chevron, all trading to the upside. Exxon, the outperformer of the three. And Dave, we heard from a number of strategists, a number of analysts on the street today, revising some of their price targets for the end of the year higher on this news. Obviously will likely push the price of crude, push the price of Brent to the upside, at least in the near term.
Yeah, it's a tough time as we head towards the summer and people start driving. Will we see 90? Will we see 95 as Goldman Sachs has predicted? Our guest earlier in the program, we're not going to put a particular number on it, but you certainly have heard discussions about $100 barrel oil coming back into the conversation. Of course, what will we see at the pump? Today's prices, pretty solid, averaging $3.51. They are up over the last week. Will we once again see $4 gas? That remains to be the question when we hit the summer months. Meanwhile, Tesla reporting record deliveries in Q1 over the weekend at nearly 423,000 vehicles, but the news was not driving shares higher. You can see the move down more than 6%. In fact, they straight in reverse. As you can see, we talked to Dan Ives about this earlier. He is still very bullish, but overall, you have to question the momentum moving forward as they continue to cut prices.
Yeah, exactly. I think that's the big question here going forward, whether or not we are going to continue to see more price cuts. Dan Ives, it sounded like he was leaving the table, leaving it the option open, at least at this point. Maybe we could see more price cuts here in the U.S., also over in China. Morgan Stanley, in a note out earlier today, also taking a similar view on this, saying that the price cuts were a huge catalyst here for these delivery numbers during the first quarter. And they also think more cuts may be in the cards here going forward. But again, the reaction on the street today, Tesla off just about 6%. Let's take a look at Disney, the company holding its annual Investor Day. CEO Bob Iger making waves by calling out Florida Governor Ron DeSantis for his, quote, anti-business and anti-Florida actions against the company. Now, the event didn't shake up shares too much. You're looking at losses of just about 0.3% here. But Dave, another one of the big announcements coming out of this Investor Day was that massive investment in the Florida parks over the next 10 years. Laura Martin telling us that she thinks it could be a catalyst here going forward.
No question about that. And she was also very supportive of these comments from Bob Iger, basically coming out swinging at the governor of Florida, and her comments directly were the Walt Disney Company will be in Florida for another 100 years and Ron DeSantis won't be. I only took issue with that statement, of course, because, Shauna, I do not believe Ron DeSantis is running against Donald Trump. He hasn't said a single word about Donald Trump, even after the indictment came down. He will use this as a rallying cry to fight back against woke businesses in the country. Even if that's not a true narrative, it's one he likes, it's one his voters support. And I think this will just bring this issue back to the surface. Not sure if that's where Disney wants it, but certainly applaud Bob Iger's strength.
Yeah, certainly he was not backing down. DeSantis, I don't know. I don't think you can count him out just yet. But we'll see.
Oh, I'm not counting him out.
Oh, okay.
I'm just saying he's not saying a thing about Trump. He needs a boogeyman because he doesn't want to go after Trump.
I see what you're saying. All right, good point. We're in agreement on this one.
Okay, fair enough. Don't think he's out yet. WWE and UFC jumping in the ring together. They'll now form a new publicly traded company worth more than $20 billion. It's controlled by Endeavor, who will own 51%. The deal values WWE at $9.3 billion. And owner Vince McMahon will stay on board as executive chairman. Keep your eye on that. However, shares of both WWE and Endeavor taking a hit today during today's session. Joining us now is Steve Olenek, Mintz's chair of sports and entertainment practice. Good to see you, sir. So investors were not impressed by this merger. Why are you?
I'm very impressed by it. Don't ever count out Vincent K. McMahon. We've got deal makers, we've got deal visionaries, we've got marketers, we've got promoters, we've got content is king in an area where there's going to be lots of cross promotion, brand creation, star creation. Look at what they're doing as a company as a whole. They can cross pollinate, they can increase their value across the board, global reach, massive platform. This is a great opportunity.
Steve, look at the names up on our screen because it's a huge opportunity, but I think a lot of people are asking what exactly this leadership dynamics, how that is going to play out, how this culture is going to be when you have Ari, Vince, Mark, Nick, the list goes on, Dana White also in the room. What does that look like?
Deal maker, marketer, promoter, fantastic visionary. This is fantastic. Who
this
doesn't
might
want
be
this?
the most volatile cocktail in business history, Steve.
No.
You're telling me this is just smooth sailing ahead?
No, I think it's going to be fantastic TV come boardroom.
Oh,
let's see that. I definitely want to see that. I think we'll have a great time watching in, but I definitely think this company is going to be a huge splash. Great pipeline in terms of M&A, global reach. This is going to be fantastic.
Any reason to be questioning this? Because at least from an investor standpoint, yes, I think it's clear from today's reaction, WWE investors were hoping for a different outcome. Any reason that maybe this isn't going to turn out to what you're sounding?
Well, it's all about execution, right? You put this company together, you look at the wheel, you look at the synergies, you do some cost cutting, you do some integration, you look at an M&A pipeline, and then you try to really blow that out and forecast it to really put together that blue chip white shoe company. And that's what everyone wants.
I do want to get into the media rights deal, which will be one of the most fascinating dynamics as we move forward. Will they move forward in that nature together, WWE and the UFC, and where will we see these media rights? Will we see an Apple and Amazon get involved? What's the future?
Great question. Now, with the combination of the both, they're going to be looking at the talent inside to be absolutely be able to do the deal. You're going to have Nick Khan. You're going to have Dana White. You're going to have Vince McMahon. You're going to have one of the best deal makers out there, Ari Emanuel. You're going to be able to use that intellectual capital to do the right deal and strike with the right companies.
What do you think about just in terms of what needs to be done before this deal gets done? Because you've been involved in a number of negotiations like this. What does the next several months look like?
Yeah, I mean, you got to always look at the regulatory. You got to look at, in terms of getting the right approvals, what's going to be needed, how they're going to look at it. If there is going to be any type of scrutiny, you're going to have to look at the consolidation, the integration, look at everyone's P&L, kind of look at that, work with your financial stakeholders, and try to put together the pieces to put that groundwork together to build out the company in terms of the vision of where they're going to go.
WWE had a market cap around $6 billion. They're valued at more than $9 billion as a part of this deal. Was price tag, do you think, the main driving force behind this marriage, or was it something else?
I think if you look at what Vince said, he wanted to get that over $9 billion, and look what he got.
Sure, Ari may have paid a little bit more in terms of a control premium, but they got what he wanted. So I think in terms of putting the two companies together, I think it's a fantastic outcome.
What do you think about the number of suitors? Because in an interview on CNBC, McMahon made it sound like there was a number of companies that were interested in WWE.
Yeah, I think it just depends on, once again, you're going to have a lot of suitors, but at what price, right? And oftentimes you get a lot of people that will tire kick and start to look, but more often than not, you're going to have to see and find the right buyer.
Vince McMahon said, or at least the narrative is that he was staying out of this and that Ari wanted him to stay. Do you buy that?
100%.
They wanted his involvement in this moving forward.
Legendary person, visionary, look what he created, great storyteller, the story's unwritten, great WrestleMania. Hopefully you guys watched it. Fantastic.
I didn't. 80,000 people, 2 nights, right?
Out in LA. Does the scandal go away? It doesn't appear to be entirely behind them.
Yeah, I mean,
payouts to the women, if of course you haven't tuned in.
Yeah. I mean, I think something like that. I mean, I don't think that was probably looked at in terms of the deal. In terms of, I think the lawyers probably looked at that and made a risk assessment tied to that. But I don't think that was going to prohibit a deal like this to ever happen or to prevent a deal like this to happen. So I think in terms of what both companies wanted and what they actually got out of it, fantastic outcome.
We definitely need a camera in that boardroom.
We
can agree. That is pay-per-view. Steve Olenek, good to see you, sir.
Thanks.
Thank you. Coming up, 2023 has already been a volatile year for the banking sector, and earnings season is looming. We'll tell you what to watch for next.
The collapse of Silicon Valley Bank and Signature Bank sending shockwaves across the financial sector as many investors rushed to withdraw their deposits from some of the smaller players in the space. But it wasn't just the regional banking stocks that took a hit. The financial sector ETF XLF posted a loss during the first quarter, falling nearly 6%. So what are we going to learn this upcoming earnings season about the health of the banking system. For that, we want to bring in our guest, Gerard Cassidy, here joining us, RBC Capital Markets Managing Director. Gerard, it's great to see you. So just first, your takeaway on where the banking sector stands right now. The worst of it, is it behind us?
Shauna, I think so. When you take a look at what has happened, it's been quite an incredible period of time, particularly with, of course, Silicon Valley and Signature Banks failing about 3 weeks ago. And what's interesting is on Friday, the H8 data came out, which measures the weekly loan trends and deposit trends for the banking industry. And everybody was very concerned, rightfully so, about the small bank deposit trends. And they dropped meaningfully the week after the Silicon Valley and Signature Bank failures. But last week, they were stable with the prior week. So that was an encouraging sign. Now, that doesn't mean we're out of the woods yet. There are still some banks that still need to address some of these issues, like a First Republic, for example. But for the most part, the regional banks, the models that banks use to run their business were extremely different than what Silicon Valley and Signature used. Both those banks relied on large corporate deposits for funding. Most American banks do not. Most of the big ones in particular, the regionals, have anywhere from 40 to 60% of their deposits from consumers, which are very sticky and are very low cost.
When it comes to the big banks, Gerard, what do you think the impact will be in terms of lending conditions and, of course, down the road, eventually on earnings?
Dave, it's a good question, because I think what we have to take a look at is what the economy is going to do. And the real GDP now forecast, which came out on March 31st, is still calling for, I think, 2.4% real GDP growth in the first quarter. And there's certainly conflicting signs about what's going on in the economy, as we all know. If you take a look at the yield curves, they're all inverted, which would tell you that a recession is at our doorstep. The leading economic indicators are pointing to a recession. But on the other hand, you look at the employment numbers, and the employment numbers are still very strong. Wage growth is still strong. And so it's really a conflicting period here. But most importantly, loan growth in particular is tied to nominal GDP growth. And we are expecting coming into this year a slowdown in loan growth to about 3 to 5%. It may actually be a little slower now, 2 to 4% from what we saw in the second half of last year of double-digit loan growth. So I think what you're going to hear from the banks when they start reporting numbers is that they probably are tightening up standards somewhat, just as a precaution, and we should expect to see slower loan growth as we go forward for the remainder of the year.
Gerard, what about just credit quality? Do you expect that to remain strong? And also when it comes to some of the revenue growth there, in terms of fees, fee revenue growth, what do you think that's going to look like?
It's a really good question. And I think you put your thumb on the critical issue for the banks, which is credit quality. And right now, coming into the first quarter, it was very strong. Many of the banks were calling for a more normalization of credit, as were we. I mean, the numbers are just too strong to be sustained. And part of the reason the numbers are so strong is all the money that was dispersed during the pandemic really enabled many borrowers, both consumers and corporates, to remain current on their loans. And so I think what we're going to see is, over time, a more normalization, which means net charge-offs need to rise. Most of the models for earnings this year, ours included, include the expectation of higher credit costs, in some cases a double from last year, because last year's numbers were so good. So we anticipate that will be the case as we go forward. On fees, it's going to be interesting, because the investment banking business, which is such a big part of the large banks' revenues, those numbers are still very depressed. Probably going to see those fees down 30 to 40% year over year, maybe even a little worse, led by advisory being the weakest. But then on the trading front, I think you're going to see the FIC, that's fixed income trading, along with currencies and commodities. Those numbers are going to be good, and the equity markets numbers shouldn't be too bad. So it's going to be a tale of two cities on the investment banking revenue. Investment banking fees down quite a bit, but trading revenues maybe up on a year-over-year basis, but certainly not down as much as investment banking.
Gerard, the numbers certainly in focus, but we always hang on the commentary, the big bank CEOs, no one more so than, of course, Jamie Dimon. As a reminder, we started out Q4 with a prediction of just about every big bank CEO of a mild recession ahead. What's your expectations for how they word what's coming down the road?
It's an interesting observation because many of the banks were and are still planning for some type of recession. And the real question is, the recent banking issues, will that turn a mild recession into something more severe? It doesn't seem to be the case yet because there was no real contagion from these problems. Once again, the Signature and Silicon Valley business models were very, very different than the industry as a whole. And the contagion problems, with the help of the Treasury and the Fed and the FDIC taking the actions they took on that Sunday night, March 12th, that kind of calmed fears of and restores some confidence in the deposit side of the banking business. But it's really going to come down to what the trends are for these banks, what they're seeing, and we'll get a read on that when they report their numbers, because they'll be seeing the consumer trends, they'll be seeing the corporate commercial trends, and that will give them some guidance on whether this mild recession turns into something steeper or does it remain a mild recession.
We'll get those results starting next week. Gerard Cassidy, great to have you. Thank you. Well, coming up, big tech is looking to conquer the artificial intelligence landscape, but wait until you see what Meta might be looking to do to change the game. Stick around.
The consumer is resilient today. People are hopeful and hopeful that they still can be prosperous in the future.
About 25 to 30% of your tenants are in fact tech, Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
We're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies.
The impending recession we keep hearing is 6 months out.
What kind of trends are you guys seeing right now?
Still seeing good consumer demand out there. The question will be, how does that consumer hold up as we get to the back half of this year? But if we see that consumer hang in like they have through the first part of the year, we'll have the ability to bring production on and serve whatever needs are there.
This is still a very young market. We're still talking about fractions of people, and by the way, fractions of activity because of COVID.
Are you seeing any sort of deterioration in demand or differences in the decisions that people are making?
That's the flip side of this. There's some positivity for those who have some savings and investments, now can get a higher rate of return, even in FDIC-insured deposits, right?
Yes.
With money markets and CDs like they've not seen in over 15 years.
Meta has announced new programs that it says allows for AI-driven robots to learn directly from humans. Yahoo Finance's Dan Howley joins us with more now. Dan, we're all freaked out about this, man. I mean, they're going to replace all of us. What are the implications here before that happens?
Yeah, this is still just early research and way, way far away from any robots being able to replace us. But Dave, this is something that Meta's working on. While we're all discussing generative AI, there's still other research going on in the AI space, especially towards general purpose AI. These are two different projects that Meta is working on. One is called an artificial visual cortex. That's the part of the brain for humans that helps process images and allows us to kind of interact with things in our world. And then the other is adaptive skill coordination. And so these two features are basically meant to help robots understand the world around them and navigate to do individual tasks. Now, the artificial visual cortex, this is something that they basically programmed in a virtual world. So think a kind of metaverse-y robot. It learns by watching videos from a person's first-person perspective, and is then able to recognize, okay, there's a chair here, there's a table here. I have to avoid chairs. If something changes in the room, it'll be able to avoid chairs and go complete a task and then go back to where it started. And so that's the artificial visual cortex. The adaptive skill coordination, that was trained in a different way, but it allowed a real robot, a physical robot, one of Boston Dynamics' Spot robots, to navigate a room, recognizing things in the way, to go and pick up an object, a stuffed animal in this case, and then bring it back to another location. So it's seemingly simple tasks, but the experts that I spoke to at Meta who are working on this basically say, look, generative AI, being able to do things like play chess, Go, those are things that robots are able to do now, AI is able to do now. Those are relatively simple because they're set instructions. The world, though, is much more chaotic. And, the way they put it is, it takes so much to teach a robot to do something that a 3-year-old can do that it's incredible. And so they're moving at an incredibly small pace as well. But, the fact that they're able to do this with the kind of technology that we have right now is really impressive. And it just goes to show how Meta and other tech companies are working to get robots to be more human-like and be able to move around more freely. When you see usually the Spot robots, they're being controlled by a controller. These are just functioning on their own.
That's a little scary to think about. I got a lot of questions, hopefully, before we start seeing some of these anytime soon. Dan, let's also talk about Apple here, the other big tech giant, showing some signs maybe pushing into AR, the VR space. GQ just did a profile of CEO Tim Cook. What did we learn about Apple's maybe ambitions within this space?
Yeah, it seems as though, he didn't mention a headset at all. That's just not what he does. And, he didn't mention any competitors by name, but you can kind of get a sense, if you were Meta, that you would be terrified at this point, just because Tim Cook specifically mentions augmented reality and how it could be used for communication and collaboration. And that's kind of where Meta hopes to bring their metaverse idea. Right now, they're using the Quest 2 for VR, some basic AR components, but down the line, they want this to be something that you can put on a pair of glasses. And, in one of the videos that Zuckerberg had shown when renaming the company to Meta, play virtual chess with someone sitting in front of you who isn't really there via AR, or, fence with an AR version of a friend. And these are things that, Apple seemingly is starting to talk about as well, at least as far as this conversation that Cook had in this GQ interview goes. So it looks like the two are on yet another collision course. And, there's no love lost between the two companies. Meta desperately wants to take control of the AR VR space because, frankly, Apple has control of the smartphone space and can tell Meta what to do with its apps. And so if Meta can control the AR VR space, then it has its own life. If Apple goes in there, not so much.
All right, Hallie, great stuff. Thanks so much. Health insurers popping today, reacting to the federal government making changes to the final proposed Medicare Advantage payments for 2024. Yahoo Finance's Anjali Kamlani, our health reporter, joining us now. Anj, what do we need to know? Clearly a big reaction here from a number of the insurers.
That's right. Good news for anyone who's in the Medicare Advantage space, and that's because these plans are about to get a bit of a bump with the rates that CMS pays out for these private plans. As you know, Medicare Advantage is a private coverage for insurance for those 65 and older and others, and it is currently serving about half the Medicare age population, so really significant portion there. Now, what we've seen is, initially when CMS proposed their new rates for 2024, it was going to decline by about 1%, but instead the lobbyists and advocates said that it would actually come up to a little bit more than that. So what CMS has done is sort of met them in the middle. It's an increase of about 3.3% from current rates, totaling about 13.8 billion, for the upcoming year. And that's an interesting number considering that last year the jump was a little bit over 4%, nearing 5%. And the insurance lobbyists have said that this year the cost itself for Medicare patients will increase by about 5%, including risk adjustment changes and the rest. So a lot of changes built into what the insurers are set to receive for these Medicare Advantage members for the upcoming year.
And some of these insurers, the top trenders here in Yahoo Finance today. Anjali Kamlani, thanks so much. Well, coming up, should stable coins be considered a systemic risk? The head of the Consumer Financial Protection Bureau weighs in next.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. In the midst of the bank failures last month, the largest U.S. stablecoin issuer, Circle, broke its peg to the dollar. This over the past year after stablecoin Terra crashed and Tether broke its peg, all raising questions about the risks of stablecoins. Friday, I sat down in an exclusive interview with the head of the Consumer Financial Protection Bureau, Rohit Chopra, who also sits on the Financial Stability Oversight Council, and asked him whether stablecoins should be designated as systemically risky. My interview.
There is provisions in the law that allow the Financial Stability Oversight Council to designate certain payment activities, payment clearing and settlement, as either systemic or likely to become systemic. At a minimum, that could provide a bit more visibility into what is backing these stable coins, a little bit more insight into how is it going to work across the system? Is there eyes and ears? Because if they do get big, if a stable coin starts riding the rails of a big tech platform or a card network, we could see it rapidly getting adopted. And we need to make sure that there isn't a run on some of these new types of payment systems. It's not just stable coins. We also have to think about P2P apps. Billions of dollars move from people to people and businesses through these apps, Venmo, PayPal. It's common now, but it's not necessarily clear always about whether those funds are insured and what would happen if there was a run. I would hate to see that, and I want to make sure there's safeguards in place so that people can have confidence that their money is always there for them.
So at this point, though, do you see stablecoins rising to the level of systemic risk?
Well, right now, stablecoins have not shown that they're ready for consumer payments. They've largely been used for the purposes of trading in various cryptocurrencies. We haven't seen it get at scale yet like we have with P2P apps, but it could. I think Facebook's Libra proposal from several years ago was a huge wake-up call to regulators around the world that if some sort of virtual currency or stable coin was on a big tech network, it could just rapidly, even overnight, become something that is very big, and that is something we would need to be prepared for.
On the online payment systems, one of your first initiatives here as director was to seek information from online payment platforms for big tech. Amazon, Apple, PayPal, Square, you just alluded to some of this. You're also, I know, looking into Chinese payment platforms, WeChat, Alipay. And I know you've been studying how firms are using this data to target ads, prevent against fraud, and so on and so forth. What have you found so far in your study?
Well, what we have seen is that obviously there's extremely rapid adoption by these types of payment apps and services. So many of us on our mobile devices now tap and pay through services like Apple Pay, Google Pay. We're obviously transacting billions of dollars that way. And I think there are some questions we have about how do some of these services decide to kick a merchant off or kick a user off? How are they actually using all the data that they're collecting through our phones and through what we buy? Are they using that to potentially not just have targeted ads, but maybe move to a world with personalized pricing? So I think there's a lot of big questions there. We also have noticed that, for example, on the Apple devices, only Apple Pay is allowed to use that near-field communication on the device. And we hear from other potential competitors, even financial companies, they want to start their own competing apps, but they can't easily break in because they can't use that tap function always. So these are all the issues that are really top of mind. Of course, we want to make sure that financial privacy is not something that is fake in this country. When you can know every single transaction that someone has spent, that's really a map of their mind and their financial life. And I think people want to make sure that that is safe and secure and only shared when they want it to be.
So then, Director, how does that inform your thinking about potential enforcement action or guardrails perhaps that should be put in place?
Well, I'm not ready to comment on that yet, but I do think you're going to see us in the coming months talk about places that we need to address in terms of risk. That may involve privacy and surveillance, that may involve issues around fraud and fraud detection, but also, fair dealing when it comes to both consumers and businesses.
And given your concerns, you've also said that you have concerns about banks' reliance on these cloud service providers that big tech offers, some of the things you kind of alluded to in your last answer. So does big tech need to be subject to FSOC?
Well, I think the Treasury and the regulators are all looking hard at cloud service providers. You really worry that if something were to happen, could it really take down a lot of core financial infrastructure? And what might be the consequences of that for the economy and society? You almost want to think about, what if there was a major attack by a state or non-state actor? What if there was some sort of outage? There is so much concentrated in a few major cloud providers. So ultimately, there needs to be a look at resilience, but also financial stability. And in as much that the financial regulators need to take action, I think we have to seriously consider that.
How quickly do you see steps being taken on that front? What kind of action, I should ask?
We don't know yet. We don't know yet. I think it's hard to know what specific tools we'll use. I think we should be open and understanding what all those risks might be. For what it's worth, it's not just the financial system that might be vulnerable to this. It could be other key sectors, including healthcare, energy, and more. So the growing power of big tech firms, whether it's in payments or cloud, it's something that every regulator I know is a little bit worried about.
Yesterday, the CFPB finalized a rule that's been years in the making. It was mandated by Dodd-Frank. You're directing banks to collect racial and demographic data on small business loan applicants. And you said that can help ferret out and deter discrimination on the lending front, and it can be used in the Community Reinvestment Act, which is looking to offer loans to underserved communities. Already, we're seeing pushback from community bankers. House Financial Services Chair Patrick McHenry says he's going to do everything he can to try to thwart this from moving forward. Your reaction?
Well, this is in the law. The CFPB was under a court order to implement it. And, one of the things I think is so important is during PPP, Paycheck Protection Program, we saw that it was able to save so many businesses, but there was data and reports to suggest that, many small businesses were not able to get credit to save their business. And sometimes that had some disparities. We want to make sure, just like in mortgages, that everything is above board, there's transparency. And we also want to give more tools for investors and policymakers to make sure that any programs they create or investments they make, they have good data around it. So this is in the law. We have to make it work, and we're working closely to make sure we can reduce some of the costs associated with getting it done. We are not requiring it for the smallest community lenders. And importantly, we're including all of those non-bank finance companies that have popped up over the years, both online and in person, and holding them to the same standards. That's just that we have to do that to make sure that there's fairness and competition.
And my big thanks to Rohit Chopra, Director of the Consumer Financial Protection Bureau. We'll be right back.
Bouncing back from your setback, tens of thousands of workers have been laid off in just the first few months of 2023. Landing an interview after a layoff can be difficult. But once you do, how do you answer questions about that layoff? Yahoo Finance contributor Mandy Woodruff-Santos is here to tell us about that. Mandy, I'm an expert in this. I could teach a course in it, but I'll let you elaborate. How do you handle that once you're trying to bounce back?
We could tag team that. It would be like a double feature. It would be amazing. I too have been in this position, and look, I have clients of mine going through this right now. It's just the reality of the world that we're in right now. But the first thing I want to say is it's okay to address the elephant in the room in a conversation. But the key thing I want to get across is it's a little bit like going on a first date after a bad breakup. You know, you may not realize if you don't give yourself enough time to heal and do some self-care that you are carrying some resentment with you, and you don't want to bring that to the interview. You want to quickly acknowledge what happened, maybe even mention that it was not performance related, it was, you know, a company-wide layoff, and then quickly pivot into, and here's why I'm so excited to be talking with you. I have a new opportunity for a new chapter, and try to keep things really positive.
Mandy, what about negotiating power? Because I feel like so many people who have been laid off recently, they're looking for that next opportunity. They don't think that they are in the driver's seat. Is that wrong?
Yeah. I mean, it's such a knock to your confidence, right? When you think about negotiating and you want to go in there feeling like a baddie and I'm worth what I'm worth. But I really encourage clients to don't settle for less than you're worth, and to still, you know, do a bunch of interviews so that potentially you can get additional leverage by securing multiple offers from several companies. That can give you the kind of leverage that you may have had, you know, when you were gainfully employed, which we know you're not anymore. So I would say, you know, take those interviews, whether you are really excited about them or even the ones that maybe you're on the fence about, to see if you can generate some leverage by getting multiple offers, and then really know your value. If you know your value, if you talk to colleagues and peers and you know, keep track of the data that you're getting from the interviews, like how much is your budget and what are you paying for someone with my experience right now, that all should go into your knowledge of what your value is. And you should feel confident asking for that at the negotiation table.
That's a great point, because you do forget your value and you actually discount your value after you've been laid off. So how important is it to rebuild your confidence? You mentioned kind of like bouncing back from a relationship. And how do we do that?
I mean, it's really a personal decision, but what I have seen work for my clients is don't immediately start sending LinkedIn messages and emails to former colleagues if you don't feel mentally ready. Take a few days for a mental health break, then maybe start crafting a couple of messages to your network. You definitely don't want to delay it too much, but you don't want to jump in too soon to the point where you're getting on the phone with recruiters or hiring managers and a friend of a friend has hooked you up with an opportunity and you blow it because you realize, oh, I didn't have time to prepare. I don't feel confident. I haven't interviewed in years because I haven't had to. And then you're a deer in headlights and you may blow it, right? So take your time. Do the mental work of self-care, but then also prepare yourself, research the company, research the people you're interviewing with, and make sure that you go in there feeling like, okay, I'm ready for this new challenge. I'm ready to have this conversation, and I want to put my best self forward during the conversation.
Mandy, this is awesome advice. I'm so happy you did this, because if I can share one quick experience after being laid off, didn't take that time that you just mentioned and applied for all sorts of jobs that my friends would say that you would hate that job. That job is beneath you. You have too much experience for that. And Mandy, I thank God for not getting some of those jobs and winding up here next to Shauna and talking to you, because you can't forget your value and you can't jump into a situation, a relationship that is not right for you. So this is terrific advice. Mandy Woodruff-Santos, great stuff. Thanks so much.
Thank you.
Come on, Shauna. It's a subject matter I can't
I know,
about.
and it was great advice.
She nailed it.
Yeah, and I
really
think so.
did.
And I mean, just look at the headlines over the last several weeks. Thousands and thousands and thousands of workers are finding themselves in that position right now. They don't know the next step. They don't know that maybe they should take some of that time to themselves, which is so important. So,
yeah,
very great conversation.
Love this. All right, coming up, Twitter has said it would begin removing unpaid verification marks, with Elon Musk already stripping one very high-profile newspaper. That's it. Nobody else will tell you who and why when we come back.
I think the most important advice during a time of economic uncertainty is be willing to be bold in the decisions that you make. There's no perfect answer along the way. Make that bold decision, move forward with it, and if it does require adjustment along the way, be willing to make that adjustment sooner rather than later. My leadership style has changed significantly over the years. I came into the CEO role in April of 2020, so just as the pandemic was starting. There was no rule book to go by. Being willing to make that decision and adjusting quickly, that's something I practiced very early on and often, and something I'm continuing to do now, especially as we see the economy changing. We can make adjustments to the business and then be willing to continue looking at the economic metrics and understanding what part of the playbook do we need to put into effect. One of the strongest things that I look for in business leadership is going to be a strong sense of business acumen and ability to communicate. The combination of those two, to be able to take what's happening in the economy as well as with the company and be able to communicate that so the organization understands why you're making those changes, is absolutely imperative, and I find is one of the things that really can drive success for a new leader. Continue learning. Stay in front of what's happening, understanding that you're not going to know everything, going back to making adjustments as necessary, but making sure that you're keeping a pulse on your own organization as well as the things that are going on outside so that you can make the best decision with as much information as possible.
Changes at Twitter today. On your screen, you see that dog? The old Doge icon has now replaced the blue bird that used to be the upper left portion of your screen. Elon Musk trolling his own users once again. Meanwhile, shares of Elon Musk's favorite Dogecoin surging today, up more than 15%, coincidentally or not, as this change comes amid confusion on Twitter over a shift that did not happen. Twitter promised to remove the verified checkmark form of all, quote, legacy accounts by April 1st. But here we are on April 3rd, and they have removed one account The New York Times and their 55 million follower account no longer has the verification check. Musk tweeting he would remove the media company's badge after finding out that the Times refuses to pay for Twitter Blue. But they are certainly not the only ones. The Washington Post, the White House, even LeBron James said they won't pay to be verified. And I thought it was most interesting what the White House said about this, Shauna. They said, quote, and this is Rob Flaherty, "It's our understanding that Twitter Blue does not provide person-level verification, so all the blue checkmark does is simply serve as a verification that you're a paid user."
Yep.
So why in the world would anyone want to pay for something that simply says you've paid?
Yeah, it makes no sense, and I think that's why you're seeing a number of people say that they are not willing to pay, whether it's $8 a month for an individual, $1,000 for a business. When it comes to New York Times, they are the 24th most followed account on Twitter. 54 million followers, more than 54 million followers. So you gotta question why Musk is doing that, why he's weighing this fight. And of course, he didn't waste any time. He started attacking the New York Times, tweeting, quote, "Their propaganda isn't even interesting." We know that he has not been afraid to attack journalists, to attack anyone who has been critical of Elon Musk in the past. But you got to question just his reasoning and why he's even doing this in the first place, because it is a hard sell. And I think a number of business accounts aren't going to be willing to pay for this.
Yeah, and it's $1,000 a month for an organization plus $50 thereafter for the employees under them. And look, this is just another example of Elon Musk really asleep at the wheel at Twitter. He has done nothing quantifiably positive since taking over there. Let's just keep score. Advertisers have fled the platform en masse. The ad revenue has plummeted. The dialogue, the discourse has arguably gotten worse on Twitter. And oh, by the way, that $44 billion valuation is now less than half of that. It's been a debacle. Oh, and they've cut, more than half of the employees as well.
Yeah, hard to see the turnaround plan taking shape anytime soon. But we, of course, we'll see how that all plays out. Well, it's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. First up, Disney holding its annual investor meeting. Now the company announcing it will be investing $17 billion in its Walt Disney World property over the next 10 years, creating 13,000 jobs. CEO Bob Iger also firing back at Florida Governor Ron DeSantis, saying the governor's recent actions against the company are, quote, anti-business.
Oil prices surging after OPEC Plus announced a cut over 1 million barrels worth of production per day. The move sent oil prices jumping 6%. However, those higher prices could cause inflation to be higher for longer, complicating things for the Fed.
And finally, an entertainment tag team, WWE and UFC parent Endeavor, agreeing to merge. They will form a new publicly traded company controlled by Endeavor, who will own 51%. Now, iconic WWE leader Vince McMahon will stay with the new company, serving as executive chairman.
And that should be entertaining. That will do it for us for Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell.